Welcome, everybody. It's such a great pleasure to be able to host you, not just for this event in general, but actually in person. We have quite a number of people also joining online, so welcome to them as well. It's really a fantastic time to live. It's a fantastic time to be interested in technology and finance. Usually, when you work at a university, you do your little ivory tower thing, and very rarely do you have the pleasure to witness the change in technology and how it affects the financial system like we are doing today. Usually, when you work at a central bank, you have to concern yourself with mundane things like African bank failing and mopping up after that, or inflation getting out of control, and you have to find ways to get that in check. But every 30 to 40 years, if you're very lucky, you can witness a fundamental change in the payments infrastructure. And this time, I think the change is different than the last change that we've seen. 40, maybe 50 years ago, we've seen the last change where we've moved from paper-based payments to digital payments. But this change didn't fundamentally affect the way that the infrastructure for the financial system works. It reduced the cost, for sure. Real-time gross settlement systems have worked just fine since then. But what we are seeing in the past couple of years with the emergence of blockchain and new technology, I think is a bigger kind of shift because it not just affects the way that we can do business, but it affects institutions and everything that the financial system has developed over a very long period of time to deal with the fundamental frictions of finance. So it's a very exciting time to talk about these kind of innovations, and today's event is exactly about that. So we have a distinguished panel of speakers in both of the first and the second panel, and I don't want to take up too much time. We're very happy to have Mureithi with us to walk us through this, so I'll hand over to Carlos to introduce the panelists, and then we get started.
So we have two panel discussions today, and we have 4 people in the first panel discussion. I'll introduce them as they come. Testing. Can you hear me now? Yes, my name is Mureithi, and we have 2 panel discussions today. And the first one has 4 members in it, so I'll invite them over so we can start the conference. And I'll start with Professor Co-Pierre Georg. Co-Pierre is an associate professor at the UC University of Cape Town, and he holds the South African Reserve Bank Chair in Financial Stability Studies. I will also introduce Gerhard van der Viert, who is a senior fintech analyst at the South African Reserve Bank. Then we have, thirdly, Peter Munnings, who is the co-founder and CEO of Adhara. And joining us online is Rakiya Mohammed, the Director of Information Technology at the Central Bank of Nigeria. So, welcome.
Thank you.
Thank you. So we're gonna discuss. Welcome, Rakiya. We are going to discuss various aspects of central bank digital currencies. And the first question I'll pose to Peter and Co-Pierre, which is, central bank digital currencies have evolved. First we had wholesale CBDCs, then retail CBDCs, and now we have MCBDCs. Can you elaborate on the difference between wholesale and retail central bank digital currencies and talk about whether we really need both forms of central bank digital currencies at this time?
Understand?
Shall I start?
Yeah.
Sure.
So I think fundamentally, and firstly, thank you very much for having me. So fundamentally, if we look at the difference between wholesale and retail, traditionally, if you look at where what money was intended to do, wholesale and retail money, if you like, have very different properties, have very different uses. And what we're seeing is developments in both of those spaces. And so retail CBDC or digital currencies, central bank digital currencies in the retail space, you can really think of as a replacement or it has similar properties to physical cash. So you and I, if we go into a store and we want to pay for something, we would pay for it with physical cash. And a retail CBDC effectively should have similar properties and be able to be used in similar ways to that. And so, you can think about things like, physical cash is anonymous. I can pay you physical cash. I don't need to prove who I am in paying it to you. It's by definition a bearer instrument. And so many of the retail CBDC properties would be related to that. On the wholesale space, it's really in the interbank market, and you've got banks who need to settle obligations with other banks, and they need to do that in a currency or in a using some asset that is fungible, in other words, acceptable by all banks, and therefore must be issued by the central bank. And that's very different. So if I'm a clearinghouse, a CME or LCH, and I'm asking a bank for margin, for example, that's a very different process to buying something at a spaza shop. So you would require a whole lot of legal agreements, a whole lot of contracts around that, and the representation of that digital asset should accommodate all of that as well. So in the wholesale market, there's a lot of different use cases. It's generally much more focused, on regulation. There's lots of regulatory requirements. There's lots of policy now that's coming out around what those tokens should look like, and that those attributes or properties all need to be enshrined or established in those tokens, which are quite different to on the retail side. MCBDC is another concept which has been introduced recently by things like Project Dunbar. And the idea is that you would have some kind of underlying utility platform on which multiple central banks could issue their own currencies. And I think it tries to address two issues. The one is, technically it becomes difficult to do what we call atomic settlement or transactions that cross multiple currencies or multiple digital asset classes if they're on different networks, because you need to have some kind of interoperability. So putting them on the same network reduces some things from a technical perspective, but at the same time you introduce a whole lot of other issues with MCBDC. But I think there are, so that's the one issue. The other issue is I think there's many jurisdictions where they don't really want to run all their own infrastructure. And if there is infrastructure that they can use to issue onto, then then that's very good for them. But you do run into problems of who operates that? Is it a proper utility infrastructure? How do you manage different regulations in different jurisdictions that relate to that? What if mostly it's one jurisdiction that's running the infrastructure and another jurisdiction can't do settlement because something's wrong with the platform? So there's all sorts of issues, and I think the kind of simplistic view of we can just have one MCBDC infrastructure, I think is a little bit simplistic. But I'll pause there and let Co-Pierre jump in.
I mean, a lot of what Peter described for me, has to do more with processes after the fundamental ledger. I think you're absolutely right for interbank markets. The interesting use cases for wholesale CBDC, where you can reduce margin, where you can reduce counterparty risk. I think they are genuinely interesting and useful. It's not a payments issue per se. Like our payment system is not working badly. We don't have I can't recall that there was a single outage of Samos, for example, or Target 2 in Europe. So retail, like RTGS systems genuinely work well. And it needs to be acknowledged. Where I think we have a lot of frictions is with everything that comes afterwards, all the processes, all the business and legal processes, and the technology that comes after the actual payment system. I think there's a lot of innovation where a distributed ledger creates sort of this unified platform where you can just do the things that we're doing in different silos, but do them on the same ledger and make them a little easier. So in my mind, if you have a fundamental ledger on which, like a retail CBDC, on which you settle any kind of transaction in the economy, nothing would really stop you from doing all the other things that you mentioned on top of that. So that distinction, I think, between wholesale and retail CBDC is almost I don't want to say historical, because it's like 2 years or 3 years ago. But, time is moving fast these days. So it's a historical distinction that not so much a technological distinction anymore. And where I think the discussion gets really interesting is when it comes to the question, how do we do this internationally? How do we do this in different countries at the same time? The answer of the past was we had national or regional payment systems. We had banks as institutions on these payment systems. And then we had to figure out how to do the interaction between different countries. And we set up SWIFT as an institution to facilitate these international payments. And that was it. I think with MCBC, what we are seeing is a replacement of institutions with protocols. And if we look at other technology developments over history, I always bring the example of the internet as a guiding principle for how we should design CBDCs, rather than how we built Facebook as a closed loop platform. I think that's like you can build a product on a closed loop, but you can't build infrastructure good on a closed loop. When the internet was built, they had very similar problems. There were many different. The older ones among us will remember like token ring networks and yellow cables that you had to pull through. And there were fundamentally different standards for those. And eventually, through RFPs, RCs, we made sure that they can communicate with one another, that it didn't really matter what's above or below the TCP/IP stack. There's just one piece of technology that makes everything interoperable. And I think blockchain and distributed ledgers are that piece of technology. So we are now exploring this much broader spectrum of what is possible. We don't have to stick with institutions, although there are some institutions worth savings. Maybe the banks, maybe we need to consider this. But other than that, we can be more flexible now.
Thank you. Peter, you mentioned Project Dunbar. So Gerhard, can you talk about, the South African Reserve Bank is involved in that project, which is actually an MCBDC. Can you talk about the goals of this initiative?
Yeah, so I'm just checking if my mic is on, so it seems like it. So, I think as a central banker, usually the first statement is views on my own, not that of the central bank, so I need to just put that out there. I am involved in various projects, including Project Dunbar, and it's interesting to note some of the comments. I think even in exploring Project Coca, which is another project that I'm on, and then sitting in on the retail project, not being part of it directly, so I definitely don't speak on behalf of the retail project. But I think the kind of the interaction, particularly if you think about DLT-based systems, is quite interesting. There are, of course, some different policy reasons, so it's maybe not so much a technical decision, but policy decisions in terms of how you implement and who you allow access for various reasons. So the question is on Project Dunbar. I do very much agree with some of Peter's sentiments. The reason for doing it, and I think the other thing that I just want to say as well, so it's important to note that these are POCs, these are experiments at this stage. It doesn't mean that we're ready to implement. Dunbar is one where, even if you read the report, we say that we've probably left with more questions at the end than answers. A lot of that actually deals with governance. So how do you implement this? I think the other way that I also maybe just want to make a distinction is if we think about COCA, so it's the retail gross settlement system, the domestic gross settlement system. whereas Dunbar is the regional gross settlement system. So there is some inefficiencies. I do agree as well with Co-Pierre. I think generally the payment systems do work well, but with cross-border, just because of the different regions that's involved, then the rules and things get quite complex, and that created a model where there's some inefficiencies. Payments sometimes are slow and expensive, so that resulted also in some work with the G20 in terms of how to improve cross-border payments, so we want to contribute to that. There's a number of initiatives under that. So one is the potential use of a CBDC and kind of specific platforms. But I'll maybe just finish with, I think one of the things that we also noted is that it's, again, not so much the DLT. So the DLT enables things at a systemic level, but it's the rules that you implement surrounding that. So unless you also, trying to find the right word, but almost just streamline some of the AML, CFT requirements as an example, and some of those checks that need to happen so that there's almost shared rules, it becomes a problem for onboarding banks in different regions. So it's not so much a technical question as opposed to like a policy regulatory question, and the technology enables. We'll stop there.
Thank you. Rakiya, can you hear us?
Yes, I can. Good morning.
Good morning. Thank you for joining us. The next question is yours. Private crypto and stable coins are two of the alternatives that are regularly being talked about. And Nigeria recently launched a CBDC, the e-Naira. Maybe can you talk about the advantages and disadvantages of these two options, in contrast to retail and wholesale CBDCs?
Right. Thank you so much. And thank you for having me. Yeah, cryptocurrencies and stable coins are private digital assets. So that means they don't have the backing of the state. So essentially people have come together and agreed that they would exchange that for value. And it's working over. Last time I checked, I couldn't combine, they have a market capitalization of almost $2 trillion, and that's something people cannot ignore. And CBDCs have their origin rooted in cryptocurrencies and stable coins. Now, where witnesses to the swings in value of Bitcoin, cryptocurrencies such as Bitcoin, when maybe from 20,000 to 40, back to 20, and so on and so forth. And it's not surprising that nobody really uses cryptocurrencies as value of accounts because of this things. Now, stable coins stepped in to try to solve the volatility problem by collateralizing the value against fiat currency in some cases, even by backing them up with other cryptocurrencies, or simply by backing them up with algorithms. So they have created an ecosystem and pushed innovation into the payment landscape. No doubt, today, if you have cryptocurrencies, you can trade with somebody, you don't need to know him. It's a novel transformation. And I doubt if anyone of us here has seen this kind of transformation in payment system landscape during our lifetime. So, some of the values it has brought, it has broken down the barriers across nations, because I can trade, I can do everything I can that I can't do with fiat currency, for instance. And the problem is, cryptocurrencies don't really have intrinsic value by themselves, but stable coins, because they are backed by fiat currencies and other things, you can say that represents their value. Now, coming back to wholesale CBDC and retail CBDCs, these are, should I say, an option of cryptocurrencies and stable coins that are backed by states. So they are just like our normal fiat currencies, but represented in a digital way, which means the risks associated with the volatility, in value, the lack of intrinsic value, and so on, do not exist for CBDC. Now, one of the other advantages is the risk of liquidity, the risk, credit risk, and all the other risks that are associated with fiat currencies are also not there, well, to an extent, on CBDCs. Therefore, what central banks are doing is they have seen the rise of digital private assets. And to
Thank you, Rakiya. The next question is for you, Gerhard and Co-Pierre. Can you talk about some of the main technical, legal, and policy challenges that should be considered when issuing CBDCs? And we are looking at things to do with universal accessibility, privacy, and the issues of interoperability.
So I guess there's a number of things. As always, we're exploring to consider the different design options involved in different CBDCs. I'll maybe pass the privacy one to Co-Pierre, because it's maybe more a retail question. So in a wholesale space, that is not so much. It's known actors, so we can work with a permissioned network. We know who the entities are. But I think something like interoperability is quite important. That's one of the things that we wanted to explore in Project Quokka 2. So if there are multiple assets on blockchain, how can we interact with that? How do we enable purchasing of securities on blockchain, and potentially even interaction with a wholesale CBDC? So as Rakiya highlighted, something that's issued by a private entity that's not the liability of the central bank. So from a Quokka perspective as well, we're not only looking at CBDC per se, we're also looking at the policy and regulatory implications of kind of the broader ecosystem, if I can call it that. So some of the things that come out of that also then tie to the third point. So and ties to the Intergovernmental FinTech Working Group's position on crypto assets. So how do we define tokenized securities? That's not fully defined in the FMA. So how do we deal with that in terms of the NPS Act renewal? How do we treat these CBDCs? How do we integrate that into the system? So I think that ties into the interoperability question as well. So with if you're thinking about renewing your RTGS system as a country, how do you replace it on the one end with a DLT-based system, or do you create integration in some other way? So I think I'll maybe stop with that. But I think the kind of the regulatory framework of how you integrate DLT-based systems into the network is quite important. I said I'll stop, but maybe one more thing. So related to the FMA as well. So if you start to build DLT-based infrastructures, that maybe collapses some of the roles or challenges some of the roles of the existing players. And so how do you think about that? And again, like, do you make them comply, for instance, with the PFMIs, so the principles for financial market infrastructures in all instances, or do you develop new frameworks? So I think the policy regulatory question, again, quite important, but it's enabled by the new technology that kind of drives the kind of business innovation change.
I guess the main challenge is that the speed of technology is much faster, much greater than the speed of the policy innovation. And in some countries, including in South Africa, there are serious impediments to changing the law just because the technology is now there to do cool new things. That's in itself not enough of a reason to change the Banks Act or the SARP Act. Or these are very serious, far-reaching changes to the playing field that we are making. So I think that is difficult. South Africa actually was quite ahead of the curve with Project Quokka 1. I think this was 2018, so this was even before the pandemic. So we have shown that we can have these discussions. Since then, I feel like there's more discussion happening internally, probably on SARP side and sort of within lots of stakeholders, but not so much necessarily in the public sphere. And I think that part of this event is we want to bring this more to the forefront, to have more stakeholders engaged and sort of bring this out into the open and have more people participate in this discussion, because it is far-reaching. So I think the challenge on the policy side is to create a sense of urgency and necessity to actually do these decisions, because the risk, if we don't start them now, is that another Libra with fewer birth defects will come and will actually work out, and all of a sudden we are with our back to the wall and we have to push everything through in like 6 months or something like that, just because there's this big international tech company coming in doing things that are supposed to be done by banks, by regulation, but because of regulatory arbiters, they can do it. So I think that's a challenge. On the technical side, I think over the past 4, 5, maybe 10 years, there have been so many breakthroughs on the technology side that things that we couldn't do 10 years ago when it comes to privacy in particular, we now can do. We have ways not just to run a permission ledger, but we can actually have private transactions. I think in COCA 1, that was possible, that you have private transactions even on a distributed ledger, which is necessary because otherwise, if the interbank market were fully transparent, every standard bank would see that ABSA gets 100 million rand loan every Monday morning, and if that loan doesn't come in and then they get a call from ABSA, the price will change quite significantly. So you can't have that kind of transparency in this market. It's actually, it's really important that we have that notion of privacy. In the retail space, it's even more important. The number one feature that the ECB found in their digital euro survey with 8,000 participants was privacy. So how do you make sure that central banks don't get into a situation where they need to collect data that they don't want to have? But we have, there has been lots of innovation with homomorphic encryption, with trusted execution environments, with multi-party computation. Like, these technologies are moving from, obscure ideas thought up in universities to actual products. And the challenge now is to have this discussion with the central banks and the technology providers to make sure that the policy can react to the new technology frontier, because the policy we have is a reaction to a past technology frontier. And it's this continuous sort of evolution that we need to manage. And I think that is the biggest challenge that remains. Like, how do we get a process that makes sure that we actually take these decisions actively and not passively do nothing until we have no choice and then everything gets rushed?
Yeah, so Co-Pierre raises quite a number of things. So myself and Peter were involved in the first Project Orca, and definitely the sentiment was like, wow, we've done this as a country, this is amazing. But I think with the second Orca, the sentiment has changed for me quite a bit. So it's more, so when are you guys going to actually do something? And it is a bit tricky. We are, for instance, through the Intergovernmental FinTech Working Group, trying to make this process easier through things like the regulatory sandbox, etc. So enabling experimentation with live transactions. However, almost at the back end of that, the process of policy making is still quite an iterative and a prolonged process. So Co-Pierre mentions the kind of the, I want to say debate, but the public, the process to get public feedback on their retail CBDC project. And these things do take time, and then you have to take all those things into consideration and then still update the law, which you then have to take through a process to draft and take through Parliament, etc. So it is a very tricky situation to be in. So on the one hand, you need to be adaptive, agile, anticipatory of the changes that are coming, but even your policy-making process still requires a bit of innovation to get that to be more agile and quick as well.
And I mean, Nigeria has shown us that it is possible to do it quicker than 4 years and counting. No critique of the SARP. They are paying my salary after all. So, but I think it is like there are different speeds at which you can do this. And the thing that worries me in South Africa is that, there's this whole process of parliamentary and like broader stakeholders, but we haven't really started any of the second. Like, there's like 5 steps, and we are at step 1. And we've been at step 1 for like 4 years, which is, again, there's a political reality, and we were distracted with the pandemic and with all the other things. But I think it's still a risk for us. We have fallen behind in Africa in just a matter of a year or so. Nigeria has sort of taken the lead.
So Nigeria issued first, and hats off to them for that. I think the thing that I would say is it's quite important to be quite accurate in terms of your policy position and the reason why you do certain things. So if you issue it to be first or second or whatever, I think that is problematic, because then you might not be addressing the issues that is pertinent to your country. And those issues might be different between South Africa and other countries. And it's quite important, because the same people that push. And sorry, I'm looking at Co-Pierre, but I don't mean Co-Pierre. But the same people that push for you to be first, if you make a mistake and you do the wrong thing and you issue something that messes up your country's economy, will then kind of be on your back as well. So it's quite important to be clear about the directives and the policy positions of why you do certain things, and that impacts the design and how you issue a particular CBDC. So it might not be pertinent in all cases. and the way that you issue it might also not be pertinent in all cases.
Thanks. And what happens, what's the risk for banks if they do not issue CBDCs? Do they risk being disrupted? Peter and Co-Pierre?
So I assume you mean central banks. I think central banks actually have a decision to make. Is how, they're in the pole position. Money supply is controlled to a large extent around the world by central banks, Rakiya said something quite interesting. She said, what is it that backs the thing that you're using to trade with? Maybe I'll get a little bit personal. So I for a long time, I have a hairdresser who's happy to take cryptocurrency as a payment. And I use it as a little experiment to see how usable cryptocurrency is. And I remember the one day I was about to pay him in Ether. So a haircut was costing me 120 Rand or so. And I just had a look at the transaction cost of that particular transaction. It was 240 Rand. So I thought a 240 Rand transaction cost for 120 Rand haircut is not good value. So that's the one thing. And then she mentioned, the volatility as something else. And I think for me, central banks have a lot of questions to ask. So Gerhard's mentioned the policy question but policy is based on really where do we want to go as a central bank, as a country. Do we want to, so I think the important thing is central banks have a mandate to manage volatility and to manage systemic risk in a country. And they're actually quite good at that. They're pretty good. Most currencies around the world, there are a few exceptions, but most currencies around the world are very usable because the central banks manage the volatility and they manage the market risk reasonably well. So they're quite good at that. And they have a lot of systems in order to make that happen. What we're talking about now is the technology or the ability for people or banks to be able to transact in an operational way without the control of the central banks. So currently most RTGS systems are run by the central banks. But if you take, for example, the Bank of England's omnibus policy, what they've effectively said is we're happy to control the monetary supply. We're happy to make sure that the sterling that goes onto these platforms is properly regulated, properly controlled, but we're very happy to hand over the operational control of that. So whether it's commercial bank groups or whoever it is, can operate an interbank settlement platform with a settlement token that is risk-weighted as central bank money. And we're very happy for whoever wants to. There's obviously rules around that policy to operate that. Now, that's not new. Co-Pierre can correct me if I'm wrong, but I think Target 2 is not operated by the ECB.
Eurosystem.
Sorry?
Eurosystem, though. ECB is more like a place to get coffee and where people meet, but the governors, they do the actual work.
So, yeah, and there's been many interbank systems that have been, payment systems that have been operated not by the central bank. So I don't think it's new, but I think that's a policy decision that the Bank of England has made to say, we will control the monetary supply, but we'd be happy to hand over the control of the operation of the network. Now that has a couple of fundamental kind of impacts into the market. So it means that, and one of the things that we raised in Corco 1 was that commercial banks can operate 24/7 if they wanted. They can operate if the RTGS system is closed. They can they can settle up obligations if they need to. It also means that these entities, so Finality would be one of them, can build a euro platform, a sterling platform, a USD, a dollar platform that are interoperable at some level and that can support multi-currency applications. So there's a whole range of things that can be done in that context. The stablecoin policy that the US has just put out recently, that's another interesting policy because effectively they are supporting both central bank collateral as well as commercial bank collateral, which has been raised now. So really supporting the concept of a stable coin and putting some regulation around that. And we see the growth of things like USDC out of that. So in a sense, the policy there is saying we will promote a token that is commercial bank, so fractional reserve money, that carries the risk of fractional reserve, which we all were very aware of, but can be now operated completely by commercial banks. So I think central banks, there is, I suppose, a very small risk that they'll be disintermediated on the monetary supply question by things like, as Co-Pierre mentioned, a very well-oiled settlement token that is not central bank backed. But I think right now the central banks around the world generally are in the driving seat in terms of deciding where exactly do they want to play in the next level, and very aware, as Co-Pierre mentioned really well, that things that we weren't able to do 10 years ago, we're able to do now. Things that we weren't able to do 5 years ago, we're able to do now. And things that we can't do now, we will be able to do in 5 years' time, which I think is his point on the policy, the decision-making around where do we want to be in 5 years' time needs to be looking forward at what will be available, what will be possible in 5 years' time, and how do we set ourselves up for that. So I think I think there is a very small risk that central banks could be disintermediated, but I think largely the policy decisions that need to be taken now will determine where those central banks will be playing. And I think it's really important that they make decisions around exactly where it makes sense for them to be there. In the context of the broader population, you and I want something that, if I walk into a store, I can make a payment. It's not going to cost me a lot of money. I can do a cross-border payment. It's not going to cost me a lot of money. And as a bank, I can do my wholesale settlements that I need to do, and that infrastructure is secure and is not volatile, and there's no additional risk that's been brought into that. So for me, that's where the central banks have a real significant role to play, is in setting up that infrastructure well, so that whether I'm a bank, a corporate, a small business, or an individual, I have the capability in my day-to-day whatever I'm doing, to be able to do the payments that I need to be doing.
Yeah, no, Peter's right on all of this. What I'm more concerned with is the change that we are seeing from the real to the digital economy. The digital economy, no matter how you measure it, has outperformed the real economy for at least the past 12 to 15 years, which means a larger part of our value creation happens in the digital economy than it did 15 years ago. And at some point, central banks need to ask themselves if that's something that is included in their measurement of price stability. And usually it's actually not, because we have no idea how to measure prices for digital goods and services, especially if they are offered from a foreign competitor. So one rationale for central banks to look into CBDCs is to say we want to make sure that we are able to see how prices change on this platform in the digital economy. What I think is a sort of a challenge for central banks of the past 15, 20 years, we got used to dealing with crises. There was global financial crisis, euro crisis, then there was a pandemic. So we central banks have gotten used to dealing with very flexible, sometimes very quickly acting policy interventions. They haven't dealt with the positive aspect that comes with overhauling your infrastructure. And that's something that we need to do at the moment while there's supply chain disruptions, inflation is peaking back up, and I think that's a challenge for central banks. And to me, there is a risk of them being not just disintermediated, but becoming completely obsolete. Disruptive innovation is defined as starting from an overlooked segment of the market and then continuously evolving until the incumbents are unable to defend against a new competitor. And private crypto, for all the bad things it has, like the volatility, it poses that risk. So what I think is important is for central banks to sort of acknowledge the tail risk, because if the 4 or 5 sigma event that was the global financial crisis should have told us one thing, is that tail risks happen more often than we think, and react in a way that they can actually adjust to this. So what I'd be really curious to hear is from Rakiya about the learnings that you had from launching your CBDC and from the discussion around private crypto versus CBDC in Nigeria, because I think that process that startups have embodied by now to continuously evolve and test with customers and then refine and test again, I think that's something that central banks need to get used to. And it's one way to say, we wanted to get it right, everything in the first go. But another approach is to say, well, we do something, and if there's a problem, we refine, and we develop a process for this refinement. So I'd be really curious to hear a little more about that.
Go ahead, Rakiya.
Sorry, I was muted. Right, thank you, Peter. And I would say that you are right. It's a continuous process, and we did have a lot of learning points. And one of the things I would like to say is we didn't go full-blown to launch all the use cases we considered at once. So we chose a use case that considered an ecosystem where the people were already used to mobile money, digital money, like the bank money. Nigeria has a very strong and matured payment system. So the subset of people we went live with were people who already had bank accounts, who already had identity, which is very crucial whenever you want to launch your CBDC. And people who are already tied to bank accounts, and I'm sure you would have read our design paper, we used a two-tier approach where we had the financial institutions playing a very key role in the distribution of the digital currency itself, the ENIR. When we launched, we discovered that there was a lot of gap in terms of the general public understanding of what the difference between CBDC and their normal digital money is. I mean, their normal electronic money, the ones they are used to from their commercial banks. Because the use of cash was really declining, and many people in this particular use case we chose had spent several months without even seeing, the inside of a bank. So it's not like there are people who actually carry cash to a teller to go and deposit in the bank. Many people were already conducting their transactions electronically. And a lot of the things that happen, the clearing, the settlement and everything are not visible to the end user. So when the issue of INRA came up, the question was, so I'm used to sending money to people, I'm used to walking into any merchant and making purchases. What is it in this e-naira now that is different from the normal commercial bank money? That was a question that kept coming up all the time. And so it was difficult for them to understand that this is a real digital representation. It's a real token that when you spend you're actually spending your cash, not like changing your balances in the commercial banks. So that was one area. A lot of education we found out was needed for the general public, apart from the other stakeholders. And again, we did identify most of the use cases we wanted to implement on the DLT, and we chose one. With that comes the issue of governance. Having identified the use cases, we discovered we needed to identify the stakeholders, all the stakeholders. And to be honest with you, it wasn't possible at the beginning, at the start, considering the time we wanted to go live with, to identify all the stakeholders. So as we progressed on the journey, we were identifying and engaging them. But the banks themselves were really partners in this journey with us, with the central banks, or the Central Bank of Nigeria. And so what I would advise is central banks that want to issue their CBDC really need to sit down, consider their use cases, have a very strong governance, define roles and responsibilities, and engage. What we did in Nigeria was to do all at the same time, and that's why we were able to cut down the time it took us to launch. Now, we set up a very strong team. We discovered it wasn't a technology thing. So we had representation from many departments across the bank. We had monetary policy involved. We had payment systems involved. We have financial policy and regulation. We had currency management. We had publicity. IT was there, several stakeholders. And it took a team of almost over 100 people focused on this project, which we called Project Giant, almost doing nothing else, like working almost 24/7 to get this done in the timeline that we did, with our technology partner. Another thing was around data control. We had to sit down and decide early enough who should have access to what. And I'm sure you must have realized that people were complaining about central banks saying their transactions and all that, lack of privacy and so on. So it was very important that we have a demarcation as to what data the commercial banks will hold and what data central bank would hold and who will have access to what. We made it very clear. Yes, we needed identity, very important, because there's the issue of KYC and AML. And without that identity, you will not be able to trace this kind of transactions. So when there was need to do that, we needed to be able to have that access right from the word go. And so we instituted that. So we had our AML people, even we had people in government working with us. And then standardization to make sure you have a seamless straight-through process so that you can have defined APIs to enable interoperability. And we had at the back of our mind the CBDC project so that we'll be able to connect and interact with other CBDCs when they eventually come live so that we can have cross-border transactions. I know you know about the PABs. We're already talking with them to see how we can facilitate that. Of course, identity framework, I've spoken about that. In terms of technology, anything that is out there on the internet, on the digital space, you need to look at cybersecurity. That was a big thing. And because you can't have people's money and payment, money online and not protect it. If that system goes down for 1 minute, it means people cannot conduct so many other businesses. So it's very important for countries to look at that. And of course, reliability, resilience. So you need to look at an architecture, even though DLT comes with its own resilience architecture inbuilt, you need to take a deliberate step to be able to do that. And apart from that, in-house, you need to build capacity so that you can take total control of the system. So your people can make amendments and respond to changes and be able to add use cases as they happen. Regulation, we were lucky in our own CBN Act. We have a window where that gives us the latitude to be able to create money, not necessarily in physical form. So we're covered, and I do realize, it takes a long time to get regulation passed through, and that's one of the reasons why many central banks are also having it difficult and not be able to go live so quickly. But we were lucky in that respect. And then we now found out that after the launch, there is support. Help desk that you need to set up, and central banks are not used to playing in the retail space. So we needed to work out a framework where we will have the stakeholders, the banks and other stakeholders play this role for us on our behalf while we are there in case they needed to escalate. So those are some of the things we did that I would advise any central bank going for CBDC to consider as they proceed on this journey. Okay, I can't hear. Am I muted? Something's wrong.
No, we can hear you.
Carlos?
Rakiya, can you hear me?
Yes, I can hear now.
Okay, we'll move to the Q&A session. So if there's anybody who has a question, you can raise your hand. But don't ask until you get the microphone so that Rakiya can also be able to hear your question.
Oh, there is a microphone here. Hello, my name is Jan. Thank you for the panel. So I agree that sometimes the central banks, they have to get things right and we don't move always super fast. And I'm a recovering central banker, so full exposure. Do you think the geopolitical situation we are now faced with, the war in Ukraine and stuff, is it going to make central banks potentially move faster on some of these things or slower, or what's your take on that?
So I guess you're asking me, Jan?
Anyone.
Let me say a couple of things. So, I fully think that central banks can be disintermediated. I think central banks in general have only been around for about 350 years. So going back, I think starting with the Riksbank, we've only been around for 100 years. So there's no guarantee that we'll be around 100 years from now. And I don't think it's only DLT. It could be like an AI 50 years down the line that sets monetary policy and collects data, even without, again, even without CBDC and these kind of things. So we're definitely not guaranteed a future. We need to adapt, and we need to know what the value proposition is, and I think that was touched on a few times. So that is in terms of bringing stability, and as of now, that's still done by human beings making decisions, but it doesn't have to be going forward. And there's a number of considerations. I think even from a regional perspective, we're in the Southern African development community, so therefore, like we obviously want to collaborate within the region. I do think that globally, some of these developments do bear consideration. So even in thinking about MCBDC, some of the considerations is, who do you allow onto the network, and how do you govern that? So, I think even then, if you see some of the sanctions being implemented through some of the networks, that also then has, it's stuff that you have to consider. Whether it makes us move faster or not, I think it depends on a country by country basis. I think you should be, and I think to something said, I don't think you need to have, be perfect in the decision that you make. I think just you have to bear in mind that your responsibility is the stability of the system. And I think even with the Nigerian approach, you can think about, again, not being perfect, but at least not, I'm trying to pick my words here, I was going to use a strong word, but not messing up the system in essence. So I think you need something that's stable, that you can innovate off of. But you shouldn't try and be the kind of the coolest thing out there. That's not the role of the central bank.
I guess the big question for me is, how do you design this process? Like, it's one approach to say we want to get it right, and we put in place a strong system. But I'm not sure that this is the most stable. Bamboo is very flexible and rarely breaks, and there's a reason why it doesn't break. So this idea of we set the rules and we can live with them for 30 years, 50 years. I think that's gone, and it's time that we recognize this. And there are alternative systems, governance systems, from liquid democracy to open democracy. There's lots more that we have learned from political science that we could use. And I think central banks, they are very hesitant to embrace it, and that rigidity sometimes can cause a risk to things breaking in a way that you don't want them to break. So I would always be in favor of having a smaller start. Like, don't roll this out across the whole country. I mean, nobody's doing that anyways. The Chinese DCEP project is rolled out in a few cities. Numbers I heard was 100 million weekly active users. So even in China, that's a big number. But start with a few regions, a few sectors, get them involved, do the learnings in an environment where you can do little damage. And if it doesn't work out, we should just walk away from things that we start. Like, we should discontinue things that don't work. There's no shame in setting this up and realizing, oh, it actually doesn't work, and we'll roll it back, and if we can't fix it. And I think central banks are a little obsessed with this myth of perfection. Like, they can't make mistakes. They are not allowed to adapt and to change. And when they do, they often get criticized, unfairly so, from people in this room sometimes. So, I mean, I think we need to cut them a little more slack to do these innovations.
And I'm just going to reiterate 3 words that I used a little bit earlier. So I think it's important to be anticipatory, agile, and adaptive in how we monitor and react to these things.
Okay, I'm on now. Thanks. Thanks for the discussion. My name is Julian, and my question is around, say, Project Dunbar or MCDBCs, and possibly having a single platform that different central banks can use to issue their currency and manage that. Does that not introduce, like platform risk, where if this platform goes down, then you've got a whole lot of countries affected, or a whole lot of central banks suddenly unable to manage their CBDCs? And this is coming from a point of view that one of the promises of DLT technology is interoperability and programmability. So, what are some of the considerations around, say, the platform risk introduced by having a single platform to manage this?
So I'll give that a stab and others can jump in there. I think it's a really, really good question. And so one of the benefits of DLT or blockchain-based technology is this amazing resilience that you get. And so there's always going to be platform risk. There's a risk that the RTGS system Samos would go down. The risk is mitigated because there's multiple backups of that. But that just speaks to the resiliency of the network. And so distributed ledgers are inherently incredibly resilient. Parts of it can go down and the rest can carry on operating. So I think the risk is partly mitigated on that. But I think you're right in identifying that, how do you set up the governance of that you don't end up with some kind of concentrated risk on a single entity, an organization, a country, whatever it is. And so, but back to Co-Pierre's point, I think you start by just trying and getting it going. So the one benefit of Dunbar is that they've said, hey, let's at least get something down. Let's experiment, let's try. And I think it always gets a little bit different when you move from theoretical money to actual money, even if it's small values. And you can get going. And to Co-Pierre's point, if it doesn't work, you change it and you keep going and building on what you do know. But I think one of the benefits of this new technology is this incredible resilience. You take Bitcoin, it's been running, it's a shambles in terms of no one trusts anyone. And that's the whole point of it, is that you've got this untrusted community who work together, and the system has never gone down because it's grown up in a way that makes it incredibly resilient. And some of the other public networks, and you get some interesting ones like Adhara Hashgraph now, which is a little bit more corporatified, if that's a word, but it's kind of corporates getting behind it and running it, but still people who don't trust each other, and who are creating this very resilient, wouldn't really call it, well, it's a resilient network that allows you to kind of pin proofs, if you like, in an untrusted and very, very resilient way. So I think one of the benefits of the technology is that you can create a very resilient platform across untrusted communities, untrusted parties, in a way that does create a utility platform, and that's quite contrary to the current, a central bank is by definition centralized, and central bank systems are generally centralized. So there's more of a mind shift change and a philosophy change that would need to take place for central banks to embrace a very distributed multi-CBDC environment. So I think it's a good question, but I think the answer is this is a technology that actually does work in that environment.
And I don't know if Co-Pierre wants to add, but I think I think to some of the questions earlier also in terms of I think there's three different models with MCBDC. So the one is kind of creating more interoperability, the second is integration, and then the third is one platform. So we explored the one platform concept in Dunbar, and as I said, it raised more questions than what we have answers for. I 100% agree with Pete from a technology perspective. The technology is designed to be resilient, but never say never. Then you'll end up with egg in your face if it does fall over. But I think some of the questions in terms of whether maybe multiple regional platforms is better than one global platform, and again the roles of like who participates and who doesn't, quite important. So if there's only one platform from a regional perspective, and you should be on the bad end of a decision to get kicked out, then where do you go to? So I think having multiple options is always good.
Thought experiment. I don't know a huge amount about the history of the euro and the eurozone and where that, what the origins of why you went that area went for a single currency. But I think there's probably a fair number of analogs with Africa and the very diverse number of nations, African Union forming and so on. So a couple of things you guys said sort of sparked this question in my head. If the Eurozone was only considering whatever challenges it was considering then, now, so if the technology of today was available when the Eurozone were looking at a single currency and single monetary area, do you think they would have done it differently? Do you think they would have gone MCBDC or something like that? And if you could wave a magic wand and had the ability to, you know, put the African Union on a particular trajectory, what do you think would be the way to pursue a interoperable, you know, monetary system for the African Union?
Maybe I can take the first step at the euro area. Historically, the single currency union was also a mechanism to create cohesion within Europe. Nowadays, it's, I think, difficult to imagine sort of Europe that is as a heterogeneous place where everybody is at war with their neighbor, sometimes internally. But it's not long ago that we had that. So the idea of creating that single currency union was an idealistic one, first and foremost, and we've seen during the euro crisis the perils of that. We had a currency union without a fiscal union, and you have the Germans to thank for that. And whenever you have a monetary union without a fiscal union, there's going to be pressure on the system, and that pressure will vent eventually. At the moment, it is venting in almost invisible target 2 balances. But if Greece were to leave the euro, for example, Bundesbank would have to write off billions of euros in debt, unless the Greeks would agree to repay it in euro, which they might. Central banks don't default, you know, by construction. But it's also not so clear what the real value of these balances is. So any system that is built with complete rigidity will have breaking points, and therefore building in this flexibility, I think, is a useful thing. In Africa, I think we have the challenge that we are way more heterogeneous than Europe was when the euro was introduced. There's a reason why we will, like Farzam often talks about, like global payments and everything in Bitcoin or some such. Shiba Inu, I think, might be the latest that you know, people are excited about. But it's never going to happen, because the reason why we have different currency unions is because it makes sense to target monetary policy in economically cohesive areas. And no method of payment will change that. So if we were to do a global monetary policy, it would be wrong all the time, everywhere, because we have to do the global. Actually, monetary policy is wrong in Europe for half the countries all the time, because of that region. Because of that reason, you can't have monetary policy in Spain be the same as in Germany, and we've seen the consequences of that every now and again. In Africa, it will be much worse. But what I think makes sense is to have a much more flexible sort of regional networks that are highly interoperable with one another, and importantly with the quote-unquote legacy payment systems. And that's actually a problem that we haven't even touched so far, that might come up in the second panel. Like, how do you make sure that the existing retail payment systems are interoperable? You can't pay from SnapScan to Zapper by now. I mean, for God's sake, it's not rocket science. It's the same QR code. Just agree on a way to do this and you know, get it done. Same for like eBucks versus whatever Absa uses as their imaginary reward system. You know, like we haven't figured out a way for how to translate between those. Why? Because it's all closed loop systems that people want to keep closed loop because they have some position of power in that tiny little loop. But I don't think that's the way that it should be built. And the challenge is really the heterogeneity. So I think the flexibility is important, that you can react to, you know, changing economic conditions in different African countries, and making sure that they can be, you know, highly interoperable. And then you don't need one single union. You need one single system on which you can create shared wealth. And actually, Africa, I think, is in a good position when it comes to the digital economy, because low-value payments that underlie sort of a lot of what you do in the digital economy, because digital objects are abundant and therefore they are cheap, except you have some weird bored apes on a blockchain, you know. That means we need low-value payments. And actually, Africa is really good in low-value payments. So I think the positive spin is, if we harness that, innovative capacity, we can actually be a leader globally for exactly that little space that will become more important. I think that's what we should harness. And then, old Europe and its ideas about this single currency, I think that's a little dated by now.
So maybe just on that, I think it comes back for me to what is backing your money, and it was a very good point that if you have if your fiscal system is separated from your payment system or your value system, you have this disconnect, because ultimately any country backs their sovereign debt, which is effectively the money supply with future tax revenue. So they have to be linked in some way. So we have the opportunity now, and back to the original question, is if we had a single, very strong, platform that central banks could issue their own currencies on and link their own issuance process to their own fiscal policy and their own fiscal processes, and then you create, so whether it's a single platform or interoperable platforms or however we do it, but a way to overcome the friction of crossing from one currency to another, of doing low value cross-border payments, to reduce all of that friction. If you could get that right, and still have a very well backed payment system, domestically, that's linked to the fiscal policy domestically, I think you then have a revolutionary new system that you can move to, because we have good central systems that are linked to the fiscal processes within countries, but they're disconnected from other countries, and there's this massive kind of divide. And to Co-Pierre's point, the digital world is definitely outperforming the current world, which is rooted in limited. I buy stuff within South Africa because that's where I live and that's where I pay my taxes and that's where I get my salary. That's all changing fairly dramatically, and so the other question is then should fiscal policy also change, because that potentially will also be disrupted by the digital economy. So, but I think we have the opportunity to start setting up some of these infrastructures, and put it this way, they will be set up anyway. Whether the current incumbents have a role in that, I still think is very much up to the current incumbents in terms of decisions that are made now for the future.
Any other question?
Thank you. My name is Thitosi, and my question falls on financial inclusion. So I like the use case that Rakiya mentioned, that in Nigeria they looked at people with digital money and mobile money, and you mentioned in Africa that we've been really good at showing how successful we can be with low value transactions. So if you look at the Bank of Central African States, what they have done, it's like 5 countries if I'm not mistaken, they have, the central bank has backed mobile money. But in the case of South Africa, if you look at mobile money, it hasn't been successful. So what's your policy as the central bank, in ensuring that as you're designing your CBDC, how is it going to achieve financial inclusion? And if you take the use case of your social grants, how is that going to be implemented and cheaper than how it's been done today?
So that's probably a tricky question. So, and there's a number of aspects to it. So again, I'm not involved in the retail project, so I'll probably not speak too much to that. I think one of the factors to consider is financial inclusion and how that's achieved. I think it also depends on how you define financial inclusion. That doesn't necessarily mean digital payments. Necessarily. It is how you create valuable financial services for different entities. I think the example of mobile money is used quite often. I'm not so sure. I think oftentimes people try and copy and paste it because it's been successful in Kenya. Doesn't necessarily mean it's the right model for us. So these are things that we consider. Again, a lot of this doesn't sit in my space necessarily, so I'm a little bit hesitant to kind of speak to that. But it is definitely, financial inclusion is one of the considerations to think about when you design a CBDC. But I'll probably stop there. I'm not sure if...
Yeah, maybe we can also hand over to Rakiya on this. But I think for financial inclusion, the important thing that people need to understand is it's not about payments. Almost everybody can make a payment. Financial inclusion is about access to credit. And what you need for access to credit is payments history. It's very different from being able to pay. And having a payments history means you need to be able to record these transactions somehow, which is in fundamental conflict with the privacy debate that we had. So that's where the governance structure, I think, is going to be really important. Like, where do you want to store this data? Do you want to link it with identity? How do you make it compliant with POPI in South Africa, or with whatever the equivalent in other countries is? I think this is the real challenge, where we haven't found great answers. And even mobile money isn't a great answer to that, because it doesn't give you this payments history. But I'll let Rakiya, who has more to say on this than I do, I think.
Thank you. So the financial inclusion is a that we want to launch. You are right in terms of the lack of identity out there, and that is beyond. So we're encouraging private sector to handle that as our intermediaries. So there's a question of whether you want to the CBDC wallet anonymous, because then people are used to holding cash, for instance, and they don't have identity, and you want to bring them on board. We are thinking of limiting the amount of money we can put something like a hardware, so that you don't need to have identity to be able to spend that a certain amount, maximum amount of money that we will define. There are some interesting products that the private sector has come up with, which we're looking at, and we believe if we launch them, we would be able to reach out to a lot of people who are financially included. In Nigeria, that figure stands at about 38.1 million at the last EFINA survey that was conducted. The second thing is we recently licensed payment service banks, and the focus is to drive financial inclusion. We're also partnering with them. As they create wallets for their customers, they're going to create in-app to enable people to come on the CBDC space. We have also discussed with them to explore the possibility of having investment products, just like happening on the street. So people have in-app on their wallet, they can stake it and have the people who have ordered them invest, and they can have some, and that way we can also. So there are a lot of interesting things we're doing on that. Very soon, before the end of this month, we will launch our in-era on USSD. So right now, the internet penetration is not so high in the country. There are few people with smartphones too. We recognize that fact. So we're going to onboard such people. Hopefully before the end of April, we would have people dialing in 997 to be able to create wallets, be able to conduct transactions, and do so many other things. So that's as far as financial inclusion is concerned.
Thank you, Rakiya. We can have 2 more questions.
If you don't mind, I'm not necessarily going to ask a question, I'm going to answer a question. I'm Kim Dancy, I work with Peter at Adhara. I previously worked for First Rand. I was part of the First Rand team that designed the FMB e-wallet. So I want to answer your question when you talk about mobile money. Have the mobile network operators succeeded in making mobile money available in South Africa? No. Have the banks succeeded in making mobile money available in South Africa? Yes. So let's look at mobile money in that context too, before we say that, throw the baby out with the bathwater just because the mobile network operators. A lot of that's got to do with the regulatory framework. that was available to mobile money. So we can have long discussions about that and why they didn't succeed. But I also agree with the point you can't cut and paste, and that is also what Vodacom tried to do in the past with their mobile money. In terms of financial inclusion, I also have a history in financial inclusion, having worked for organizations that are focused on financial inclusion. I think we have to be very careful to look at CBDC and say it's the solution to financial inclusion. Without an ID, there is no financial inclusion. Whether it's credit, whether it's a payment system, whatever it is. So fundamentally, I've always been of the view, before we talk about anything else to do with financial inclusion, we need to get the ID piece right. Or we have to have products that are very, very, very low value. But even then, I think as a regulator, I don't know if Gerhard will answer here, but the regulators I've worked with are still, don't have an appetite for anything moving across a payment or a credit network that doesn't have an ID related to it. So let's be very careful when we look at CBDC as solving financial inclusion. I think we should rather look at getting IDs right, certainly across this continent. Thanks.
Yeah, maybe I can comment on the ID. I think in South Africa, we are not actually doing all that badly on identity. I think we had the numbers. It was over 85% of people have some form of national ID. Part of the, and actually, so for all the criticism that is due to Home Affairs, and all of the criticism is, valid when it comes to Home Affairs, the one thing they actually get sort of right is the digital identity API, so that we have various providers in that space. And with, I don't like self-sovereign identity as a concept because it doesn't have privacy in it, but with SSI, you can create identity that is independent of government verifications. We can still, track, you could use marketing cookies to track someone if you wanted, and people are doing that, and it creates a form of ID, and your advertising ID that's unique to you, sort of. So there's ways to address the identity challenge in these systems. The bigger question is always to me, where does all the data sit for this? Does it sit with the central bank, who doesn't want to have it, who probably shouldn't have it? Does it sit with service providers who onboard all these individuals? And then you can make, and I think the CBDC actually can actually help here, because we can create a new consensus around, should there be low value transactions that don't require identity? And I think that debate in the existing payment space we can't have, because FATF is sort of binding, and the correspondent banking system is the way to enforce it across the world, whether you like the US or not. That's just the lay of the land. But if you don't need correspondent banks anymore, you can have a new consensus around where to draw the line. And that's an example of where the technology is shifting the policy options that we have. And we can have low value until 1,000 Rand. Nobody cares if you have 1,000 Rand a month or 5,000 Rand a month transaction. It doesn't matter for KYC, for FATF. It's not from anti-money laundering purposes. It's a pure convenience. The risk with that approach is that you turn privacy from a right into a privilege. So it's like sometimes the ECB, for example, experimented with privacy vouchers. So what you need to do is you need to make sure that the ledger that you use to have these low-value payment systems has privacy built in, that it's not just your personal identification is not attached, but that you can't be re-identified. But there are solutions now to this. So we can move the policy debate, and I think nothing should be off the table at this point. If that is really the impediment to including millions of people in Africa into the formal payments and later the credit landscape, then by all means, screw FATF and those rules. Without correspondence banking, you can't enforce them anyways. So why should we adhere to them anymore? I think we should be bold when this is like directly affecting millions and millions of people that live at the bottom of the pyramid. That their lives are made miserable because they are excluded from financial services. So we should, I think we should go to great length to assist them. And we should be a little more bold than what we are at the moment.
Greatest of five, better.
Well, as a country.
But I'd be interested to hear a Nigerian person to speak to us about BVI, because the bank verification identity in Nigeria, did that help in terms of what they've been trying to achieve?
She can't hear you because you don't have a mic. So just doesn't reach Nigeria.
Excuse me, sorry. From Nigeria's perspective, you have the BVI in Nigeria, the Bank Verification Identity. Did that make a difference in how you looked at your CBDC rollout?
Yes, it certainly did make a difference. So we have the BVN and then we have the name. So the BVN is completely under the control of the financial industry because it was our creation, it was our response to lack of proper identity from the government at that time when it was created. So it was very easy for us to leverage that because it's being controlled by an entity that is wholly owned by the banking industry itself. So we just leverage on that and gave us a very quick leap towards the implementation of our CBDC. Then only those people who have the BVN and whose details we already have to be able to identify and onboard them quickly, enable them to create wallets and start transacting. And yes, it did.
Thank you. We can have one last question before our panelists give us closing remarks.
Hi, it's Brandon. I'm going to reveal my lack of knowledge in this space. Technology question, really. Rakiya mentioned two of the key impediments on cryptos being volatility and friction and costing of transactions. I guess there's a third, right, which is the energy cost of creating and maintaining the Bitcoin ledgers and the like. What is the situation with CBDCs? Are we facing a similar challenge in terms of global energy consumption with the world moving in this direction? And how is that going to be addressed?
So Peter is eminently more qualified to speak to the technology piece, but I think definitely just even from a central banking perspective, we belong to, I forget what it is, but something like the Green Network for central banks and things like that. I think we'd probably not implement a model that is proof of work based, that is going to consume all the electricity power in the country. I think that would not be the way that we would go. I don't know. Pete?
Yeah, so proof of work, which is the thing which burns lots of electricity, has actually got nothing to do with the payment or the settlement process. It's to do with who has the right to produce the next block, effectively. And if you're in a completely democratized network where there is no governance structure at all, you need a way of saying, Jan is allowed to produce this block, and then Carlos is allowed to produce the next block. How do you determine that? And so the proof of work is really just a lottery where Jan guesses a lot of numbers, and Carlos guesses a lot of numbers, and Gerhard guesses a lot of numbers, and whoever guesses the right number first gets the right to produce it. And now guessing those numbers is the thing that costs the electricity. So you have warehouses full of PC boards that are just fine-tuned for guessing the right number, and it's a very clever algorithm that everyone knows what the right number is, but how to guess the inputs to get to that right number is really difficult. And so the electricity gets burned, and the more value that Bitcoin has, the more money people are prepared to spend on that. And so in a nutshell, if you have something where there is no governance, you have to have a proof of work, or as Ethereum and Cardano and a few others are moving towards, is a proof of stake model where instead of saying, buy all of this equipment to do the work, there's a clever way of saying, well, rather just stake all of that money or that ether, whatever it is, and then you will get the right to produce X number of blocks based on your stake, which is a lot more energy efficient in terms of how that works, but it's arguably less democratized. Because it doesn't have that element of I've done the work, I get the right to produce the block. In any kind of system where there's any kind of governance model, you can bypass that all completely. So you can simply say, well, we have a set of banks who are going to be the validators, and we just do a round robin between the banks. And if any bank does something wrong, we have a whole lot of rules as the regulator that we fine them, which we're good at doing. We've done that for a long time, or we have other ways of making sure that the actors all play nicely with each other. And there's a number of, from kind of a very high governance model all the way down. And it's really only the zero governance model that requires proof of work, and arguably there's better ways of doing that now. And it's really, I suppose, Bitcoin maximalists who would still stick to saying that's the only true way of being fair, and it, in terms of doing that. So when it comes to the actual distributed network, it doesn't actually require very much energy at all. It's more around a structure that doesn't have any governance that you need to do this proof of work that requires the energy at the end of the day.
I would make a distinction actually between consensus and governance. Like modern blockchains with proof of stake, they don't have a significantly higher energy consumption than retail payment system. It's a little higher because it's distributed, but the retail payment system is backed up. And for Algorand, I know that because there's other ways to solving this, you need to randomly select who proposes the next block, otherwise you get collusion and problems like that. But that's one of the examples of where technology nowadays is able to do things that we couldn't do 5 years ago. So verifiable random functions are a way to solve this and to get this randomness, and then you can get to 1,500 transactions globally distributed, or if we talk about nation scale CBDCs, it will be possible in the near future to do 46,000 transactions per second on a distributed network. The challenge is not so much the consensus. There are ways to deal with it, but the governance is really key to this. Who do you allow to be a node runner? Who do you allow to participate in consensus? Who do you allow to change the rules of protocols? It's not just the central bank sets the rule once. There will be evolutions that require adaptation. And either the central bank, every time they have to make up all the decisions, or they end up in a rigid system, or you set up a more malleable governance structure. But again, with new blockchains, you can do that. And actually, blockchains might be a nice way to set this up because of decentralized autonomous organizations. You can actually organize these decisions in a much more meaningful way than we could in the past. And I think there's a lot of potential. And yeah, the proof of work, that's really, I think, it's a thing of the past. You can do it just like you can use fossil fuel. Actually, pretty much the same difference,
Thank you. I think we'll take closing remarks from our panelists. Rakiya, are you there? Okay. Then let's start with Peter.
So maybe just want to echo what Co-Pierre started with by saying I think we are in a once in a lifetime space where I do believe that things will fundamentally change. I have a 12-year-old son, and he says to me, "What do you do at work, Dad?" So I say to him, "My boy, what I'm doing is I'm making it so that when you transact when you're an adult, it's going to be a completely different experience to me." And you'll ask me to tell you the stories of, remember when we had to send money to England and it took 4 or 5 days to get there, or when it cost $100 to send a transaction to Malawi. So I do believe we're fundamentally in one of these once-in-a-lifetime shifts. I don't think it's just the technology. I think, Jan mentioned there are crises happening. We had the global financial crisis. We've got many other crises that are happening, and we have to respond to that in a way that's appropriate. And so there's a technology element, but I think there's also a kind of a general shift. And like Co-Pierre, I've also studied the birth of the internet extensively, and how it came about. And it was a very small group of people who were fundamentally kind of fixated on this thing, and who made it available to the general public, and it was laughed at for probably 2 decades, from the 70s to the 90s, before it really was taken seriously. And now it fundamentally has changed everything we have. And I feel like we're in the second decade of there's still a lot that needs to be worked out, but we definitely fundamentally starting to shift things. And I firmly believe that that our ability to transact is going to be very different, and our experience in transacting is going to be very different in the next decade as it was, you know, when I was growing up. It wasn't that long ago.
Yeah, so I think let me try and pull my thoughts together very quickly. So, you know, I think there is the need to be deliberative about some of these things, to think deeply about these things, to think about the implication. That doesn't mean that we need to be perfect. You know, I want to stress again, I think the policy-making regulation needs to become agile, adaptive, and anticipatory. So you need to be able to look forward at what's coming and be able to adapt to that quite quickly. The reason why I say that is I agree with this idea that we are going through a fundamental shift, but I also think what comes with that is that the next shift might not be another lifetime away. So you need to design so that going forward, again, you're agile, adaptive, and anticipatory, that you can continue to adapt to whatever emerges. But I'll stop with that.
I think the challenge with fundamental shifts is that they're difficult to recognize. There are inflection points that really matter for how history evolves, how technology evolves, how societies evolve. Who would have thought that the debate about RSA standards, for example, where the US government tried to undermine the RSA encryption standard and a ragtag group of cypherpunks fought against that, they were successful in this fight against the fundamental invasion of privacy that would have come with undermining the encryption standards underlying all communication on the internet. If that had succeeded, privacy would have gone. But who would have thought that this tiny technical discussion would have such far-reaching consequences? Or when Unix was developed, the decision to implement the copy function as a function that has no memory, where you never know where a file comes from, that has fundamental consequences for how data is processed, how it's analyzed, how it's stored. And I think we are in a similar inflection point at the moment where we need to make a decision, how do we organize the digital economy? If we move into not just economically a more digital world, but socially, where more interactions are happening socially. I mean, half the participants are here via Zoom. If that reaches a point where we will send our avatars to conferences instead of showing up in person, which is not 20 years away. This is 5 years, maybe 10 away from actually happening. We need to fundamentally decide how do we organize that digital life. The way it is, the technology is set up at the moment with centralized data store and sort of centralized processing of the exchange of value, we will end up in a feudal society where, Emperor Mark rules and fights against Elon the usurper for the dominion of all of cyberspace. I think that is the one direction we can go, and we can try to set ourselves on a different path where privacy exists, where self-authorship exists in the digital realm, and central banks, even if they will not like being dragged into this, they actually matter at this point in time, and the decisions that they make around the infrastructure, it really matters at this point in time. And if anything else, I hope that discussions like this will sort of help to contribute to this discussion and sort of make central banks more sensitive. It is not just about the payments. It has far-reaching consequences in 20, 30 years' time. And yes, we need to think things through, but not acting carries at this point as much, if not greater risk than acting wrongly. And that sense of urgency, I hope that central banks will pick up on it. And I think after Libra, they have, by and large. So the internet took 30 years where it wasn't commercial. Between 69 and 90, when it was moved to NSFNet, it was purely non-commercial. And then it was made commercial, and 5 to 10 years later, we had that little bubble thingy that we had to sort out. But since then, it's smooth sailing. And that time, that 30 years, is what central banks, I think, would like to be deliberative. But maybe we have to condense it into 5 years, maybe. But it is important to act.
Thank you, Co-Pierre Georg, Associate Professor at the University of Cape Town. Gerhard van de Viet, Senior FinTech Analyst at the South African Reserve Bank, and Peter Munnings, Co-founder and CEO of Adhara, and Rakiya Mohammed, who unfortunately had to leave earlier, the Director of Information Technology at the Central Bank of Nigeria. Thank Thank you so much for your time and input. Let's give them a round of applause.